Hello active traders, this is Ken Calhoun from TradeMastery.com with the channel dedicated to helping you make bigger winning trades more often. Now, I'm a big fan of authenticity and transparency, so take a look at these two screen caps of verified proof, a tax return proof that I did trade $4.9 million worth of stocks and ETFs in a single year back in 2009. Now take a look at this screen cap showing my realized P&L, around $16,000, about $1,000 a month plus that I earned for doing all that testing in my account for my Interactive Brokers trading account. In this video, I'm going to share with you some very valuable lessons learned. A lot of that trading knowledge became the foundation, the focus for a lot of what I teach traders at Day Trading University and Trade Mastery and my other network of websites, and also in my Stocks and Commodities magazine articles and my Money Show live appearances. It's all based on the actual results of real money trading that I've done. And so really valuable tips coming right up. Okay, so what does it take to be a winning trader? How did I make winning trades, have a profitable year doing just under $5 million worth of real money trades in a single calendar year? Well, I've got a list of items here that I put together. I can't remember all of it off the top of my head, but I'm going to go through these very quickly and give you my professional trading insights on them one at a time. The first one is to, as I did, test. I did all that testing that year to form a foundation to refine what I've been learning since the year 1999 and before. In 2009, I thought I'd take it up a level and do a lot of testing, experimentation, practice, whether it's things like breakout continuations or gap continuations or gap fills or pivot trades or classic candle patterns or classic Western technicals like cup patterns, ascending triangles, acceleration ramps, and the rest of it. I tested a lot, and that's my first tip for y'all, is be sure that you test out your ideas in a demo account before you trade live capital. And when you do trade live capital like I did, make sure that you're trading on light share size or light lot or contract size, depending on what you're trading. So that's tip number one, is do a lot more testing carefully with minimal risk up front so you can start developing your own personal trading plan that makes sense. Okay, the next tip is automate your exits with sell stop orders. That was one of the keys to my success that year and continues to be the strategy I use right now. I automate my entries and exits with buy stop limit orders or sell stop limit orders so that you automate the process. That takes a lot of ambiguity out of things. If you know the price that proves your trade wrong ahead of time and you set that up in your brokerage account, you can do 5, 10, 15 trades in a day without having to manually click through the charts and manually set things up. You do set it up manually on the front end, but you let the market price action exit your trade for you. So let your brokerage account do the heavy lifting for you and make sure that you're using automated buy and sell stop orders, probably more so for 100% of your trades. It should be pretty much all automated. All right, tip number 3. Always use, and probably the most important one, is to always have very tight stops. And by that I mean for a swing trade it may be for me up to a point or two. For a day trade, anywhere from break even up to maximum of 40 cents. But usually I like to keep it 10 or 20 cents maximum. Make sure that you're using tight stops. So there's the price that proves you wrong. And kind of hand in hand with that is use dollar-based stop losses. So for a swing trade, regardless of how many shares I'm in, if that trade goes against me, say $200 or $300, I'm likely to get out of the trade because I can always re-enter up at a new high. So think about it. What makes sense for you personally as you're looking for the difference between very tight stops, which is how professionals trade, and big loose chart-based stops, which is how amateurs trade and lose their money? When in doubt, get out. When in doubt, go to cash. And you'll find that having tight stops is one of the hallmarks of a good professional trading approach. Ridiculous. There's no such thing as, almost no such thing as ridiculously tight. If you look at the real money trade examples on my forum at www.tradingtalk.com, it's got over 100,000 views on the forum of real money trade screen caps from both my Fidelity and Interactive Brokers accounts. You see a lot of the stops are even under $10 or $20. That's fine. Use real tight stops. Number 4. Trade small and re-enter. I've got maybe a dozen or so I'll go through them quickly. Trade small and re-enter your positions if it goes against you. So By that I mean for stocks and ETFs, maybe 20 or 30 shares. No more than 100 shares on the front end for swing trading. For day trading, maybe 200-300 shares up to 500 shares. You should not be day trading 2,000 or 3,000 shares of some thinly traded pop and drop, circuit breaker halted, cheap under $10 low float BS stocks. That's a gambler's losing way to day trade. You want to trade more cautiously. If you're day trading, anywhere from a few hundred shares up to maybe 1,000 shares is my comfort zone at least. And swing trading, really small, always under 100 shares with the thinking I can always scale in. Or if the trade proves me wrong, I can re-enter on a subsequent breakout above the current high if the trade stalls and goes sideways and consolidates, or it goes against me and I have a stop loss. Well, boo-hoo, it's a tiny amount of money. I can always re-enter the trade on a breakout continuation. Next, volatility and volume, the two V's that do us good as a trader. Make sure that you've got both, volatility and volume. You run into a lot of trouble if you trade highly volatile instruments that have thinly traded volume, which is very dangerous. So, for example, you should never, or at least I never trade stocks or ETFs under 500,000 shares, preferably 1 million shares or more daily average volume. So you should not be trading thinly traded penny stocks or pump and dump $3 stocks that only have 50,000 shares a day, because they're easily manipulated or front run by dishonest educators or people running chat rooms. They'll put on a big trade, then they announce to hundreds of it's a con, it's a long con. They'll put on multi-thousand share trade of something that's very thinly traded on light volume for a day or a swing trade, and then they say buy it now, it's running, and then when it starts to run up, that's a classic pump and dump scheme. Then they sell into their buying victims as the price action goes up. So avoid light volume instruments. There's an old saying at Wall Street and elsewhere that says there's safety in numbers. So make sure that you're trading highly liquid instruments that also have enough volatility. And that brings me to my second point. From a volatility trading standpoint, you want stocks that have at least a 1 point range or more. Like the previous day's trading range should be at least a point and a half or more, usually in the $15 to $50 share range for intraday trades, and for swing trades, a stock that has a minimum 10 or 20% range. So for example, say on a 90-day chart, a $40 stock, if it has a range of 36 to 40, that's the minimum. I'd prefer to go, say, from 36 to 44 for like a 20% range. That's good. You don't want to trade a, say, high volume, low volatility instrument, like Microsoft or Intel, that may only have a few points of range for a swing trade. You want charts that, once you put on a successful winning trade, can go multiple points in your favor. So you need both volume and volatility. And trading those intelligently takes practice and patience. So that's where testing comes in. Next point, only trade when you have a distinct edge. In my $5 million year, or I should say maybe $4.9 million worth of trading year that I did successfully, I vastly remember. The reason that it works is, at least for me, I don't care how any one trade works out or how any 10 trades work out. I only trade when I have an edge. So maybe I'm throwing a lot of darts at the market to test out different trading strategies, but I only want to still trade when there's things like increasing volume on the right side of a bullish cup, or increasing volume on a gap continuation, avoiding trading right under previous resistance areas, trading with a safety buffer above the obvious resistance to avoid false breakouts. All those lessons learned that I teach in my subscription services and courses and whatnot are all based on real money trades. You have my word on it. It's very important from an authenticity and transparency standpoint that you don't just learn from guys who talk about charts for a living but don't have any tax return proof to back up that they're actually real traders who could actually really trade. So that's just my words to the wise, is make sure that anybody can talk. Money talks, BS walks. So make sure that you're trading, learning how to trade from people who can prove with brokerage, P&L, screen cap proof, and tax return proof, and all the rest of it, they're the authentic real traders and have had at least a profitable year here and there. So, but anyway, make sure that you trade when you have a distinct edge, when you've got the edge, when you've got an advantage in your trades. And what the way to develop that in a way that makes sense for you personally is to go back over your last 50 or 100 trades. That's what I used to do. I'd go back over I'd even print out charts of my trades, put my wins in one 3-ring binder, print them out, put the stops in another set of binders, and look at the difference between the two visually, and what is my edge based on charts that worked out versus charts that stopped out. Okay, so develop your own personal edge, whatever that is. There is no holy grail or magic indicator that'll get you there. Your path to success is going to be uniquely your own. So make it your own by testing and finding out what you're personally best at from a personal strength and personal skill development standpoint. Next point. Get to a point where I need to rush on this now because we're getting long here. Get to a place where you're avoiding uncertainty by being very binary in your trades. By binary, I mean like a light switch, off and on. Either it's a good trade or it's not. As a new trader, I remember you'd have, there's obvious great trade setups and very small group of obvious bad trade setups and a lot of gray area in the middle. And this is important lesson learned. You have my word on this. As time goes on, that gray area in the middle starts to evaporate and you get to very binary. Here's the group of winning trade setups and here's all the ones I should avoid. And your uncertainty compresses to where it goes away over time or gets reduced. I can instantly look at a chart now, having done so many thousands of real money trades, and know exactly where my entry, my exit target, and my initial stop is going to be, and where I'm going to scale in if it goes in my favor. So try and get away from uncertainty and get to more binary decisive area. And the way to execute or implement against that, again, is using automated buy and sell stop orders in your brokerage account so you're not second guessing yourself. Because if you're like, your experience is like mine, you have a trade that goes in your favor and then it goes against you, and then you have maybe a tight stop and then you second guess the stop and say, well, maybe it'll come back to life if I push the stop down just a little further. Does that sound familiar? And so then you push the stop down a couple more points and sure enough the price doesn't come back to life and it keeps on going down, and then maybe you add to losing trade, which is a stupid idea, and push your stop down further. Epic fail. Stop the madness. There's got to be a better way. It's always using tight stops, re-entries at new highs. Anyway, those types of lessons learned are the things I want you to take away from this. Next, I'm a big fan having a background in total quality management and being a statistician at the Ford Motor Company and an engineering background. I like to use a step-by-step flow chart or a process. You may have seen my flow charts on my website at trademastery.com. You do want to be able to identify step-by-step your scanning, your criteria, your entry signals, the trade management side of it, and your exit. So you've got all of that mapped out ahead of time, not on every single trade, but a general process that you use kind of for every trade, kind of like a template of trading. What's the process that you use to manage your trades? Avoid shiny object syndrome. We're getting to the second half of this. We're almost wrapped up. Yeah, and you know who you are out there. You chase all these educators out there with their magic names, and they come up with these silly BS internet marketing names for obvious chart patterns. The only thing you need to trade correctly is risk management. It's all about money management. It's a lot more about the math, as I've said for years, than the chart patterns. Trading successfully, unfortunately, most of the educators don't even trade, so they don't got the math to teach you. They can't teach you about the money management except at a very abstract theoretical level, because they're not real traders. Those of us who are real money traders who have actually traded as much as 4.9 million in a single freaking year, I know how to trade, but it's almost all about the math and volatility, whether historical volatility, implied volatility, position sizing, scaling, exiting trades when they're wrong, adding to the ones that are winning so that you leverage up on a continuous move for your laddering in or layering into a trade stepwise. The point is, avoid shiny object syndrome where you're out there chasing every new kid on YouTube or every new shiny object indicator or magic indicator software plugin for your favorite charting software, and you too can make a fortune on Wall Street. That's a bunch of bull honky, and you should know it. Well, listen to your wives, for guys out there. She's probably saying, "Really? You moron, don't go spend, $800 or $1,000 on some shiny software system, because look at all the sales copy. It's a bunch of BS. Look for tax return proof or brokerage P&L proof that the person you're learning from actually can trade. That's the proof, right? That's what you need. So don't be out there shiny object syndrome. Hey, look, I found a new something else, and you're out there in search of the Holy Grail. Stop the madness. Next tip, lock in profits early. As I've said since 1999, good trades feel like you're a little bit late. Like, really? Am I going to wait that long to get in? Yeah, because you want to avoid a false breakout. They're kind of late to get in and then early to exit. Bad traders do the exact opposite. Like I used to do back in the day in the 90s when I was learning all this stuff. You try and get in at the first sign of a breakout because you don't want to miss out. And then when it runs against you, you keep rationalizing the trade and take a big stop loss. So that's the losing early entry, late exit approach. The winning approach, at least I found in my own real money trades, yeah, my word, it's very important that you learn this, is kind of feels uncomfortably a little bit late. Like, am I really waiting? But yeah, you want the momentum to build a head of steam, kind of like a locomotive that starts off small and then it goes so fast from a price action standpoint, you're in on a winning trade, and then get out the very first sign of trouble. Whether using a candlestick pattern like a shooting star or bearish engulfment, or combining that with, say, whole number resistance, or a price of 9 or other good place to exit the trade and lock in a profit early. That's how you sweep profits out of the market, is get in a little bit later than is comfortable, then get out at the very first sign of trouble. Because in the back of your mind, the fear of missing out, the FOMO, that's what keeps traders in bad places where they blow up their accounts because they wait too long to get out. I've worked with thousands of real traders, both in my money show appearances and online with thousands in my webinars, and reached tens of thousands through my technical analysis of stocks and commodities and equities, and back in the day, Active Trader magazine articles. And the thousands of traders I've worked with, I distinctly remember most of you guys trade choppy charts and you're too late to exit. And you over leverage. You guys, just speaking in general to every thousands of people who are watching this, you guys trade too much size. So, if you're trading options, 1 or 2 contracts, or E-minis, 1 or 2, maybe up to 4, but 1 or 2 contracts. You don't go in and throw Hail Mary passes at 8 contracts or a dozen contracts. For stock traders, you do not day trade 3 or 4 or 5,000 shares at once. That's a complete moron's amateur approach. The people who advocate that are usually guys who are in their 20s and 30s and were in kindergarten when I was trading, right? So make sure you learn from people who have real depth of experience and expertise. Just because some of these young kids are out there and they're great on social media and getting YouTube views and Facebook and Instagram likes and all that does not make them experts. It's kind of a social proof thing that makes it exciting because you got so many people following them, but they're being misled. So make sure you learn from those of us who are established industry experts with at least 15 or 20 years of experience under our belt. Here, right? People who actually have the wisdom and expertise to help you guys take your trading from where you're at to where you want to start getting it carefully, intelligently. It's a little mini rant off. So lock in profits early. The next one I already mentioned, the math is more important than the chart patterns. Look at one of my earlier YouTube videos called the Unrealized P&L Indicator. Your unrealized P&L is a lot more important than the chart pattern. So if I'm up in a trade, say $800 on a swing trade, and the unrealized P&L the next day drops down to, say, $650, I'll go ahead and sell that puppy and take my profit because it's starting to pull back and erode my open profit. So unrealized P&L, the math side of it's a lot more important than simply looking at charts. The charts give you permission to trade it because you can visually see volatility. That's all the value of charts is strength of pre-existing uptrend, technical signals that you look at like the volume, is the volume increasing, is price action at a new high, do we have classic either candle or Western technical patterns? That all kind of qualifies the trade. But managing the trade once you're in is a function more of the math than you would think. It's a lot more important to look at the unrealized P&L column than the chart once you're in a trade live, because that's where, at least if your experience is like mine, of all the testing I did in that $5 million worth of real money trades, $4.9 million worth of real money trades I did in a single year, late exits is the thing that evaporates your profits more often than anything. So make sure you correct for that. 3 more tips. Patience and discipline. Enough said. I'm not going to berate that, but from a practical standpoint, patience to get in when the signals are right, when the planets line up, when you got your technical breakout signal with the volume confirmation, and you've got a good market. If you're looking at things like you should if you're day trading, you should look at the trend, the VIX, and the tick, especially the ARMS index, also known as the trend. Look at your overall S&P. Are we bouncing? Are we sideways? Are we up? Are we down? Use that as the kind of front load for market volatility. But trade markets first and charts second. So make sure you understand the market volatility and its impact on your personal trades, and give a lot more weight to the market. It's kind of like if I'm out golfing or something, I can golf with the same exact golf clubs and the same exact swing, but have wildly different outcomes based on if there's, say, a 15-mile-an-hour crosswind or not, and if I adjust for it correctly or not. And for those of you who are golfers, you know what I'm talking about. Or if you're driving, and if it's a nice sunny, clear day versus snow and ice on the streets, like we've been known to have here in Colorado. Wildly different outcomes and different approaches are needed based on the environment, not on you personally. So the same thing with the charts. The same chart could be traded the same way with wildly different profit or loss based on the market volatility and its wind under the wings or lack thereof, or contrary volatility for that particular position. And that's true for any kind of market you're trading. Wait till 2-day highs. And this one is one of my favorites. At Thousands of Real Money Trades, my biggest winning trades are those in which I enter when the stock chart itself is above the previous day's high for a long, or the S&P or the NASDAQ or the Dow or the Russell, whatever, mostly it's S&P, is up at a 2-day high. That's where the magic starts to happen. You want to avoid trading inside ranges, or what we call, in street talk, we call those end days. There's end days and out days. End days are things inside the previous day's range. Don't do that. Out days are where institutional money flow comes in above the prior day's high. And that's where you want to start putting on your trades. That took me a lot of time and effort in real money trades to learn. And last but not least, don't over leverage. Small is smart. So don't over leverage. It's much better to, maybe it's not, the lesser of two evils is over trading. I'd rather see, at least what I found, I traded very aggressively that year. I was doing 4.9 million worth of trades profitably. I made over $1,000 in net profits every single month, $16,000 profit. Not a big fortune, but at least I got paid for all my testing work I did on everyone's behalf, yours and mine. But it's the lesser of two evils is to overtrade. It's better to trade more frequently with smaller size than it is to trade, say, 1,000 shares or a dozen lots or contracts or whatever you're trading on large size, because you want to minimize your upfront risk. Okay, so the wrong way to trade would be 1,000 or 2,000 shares of some cheap stock, so you're over leveraged in your account, and it pops and drops, wipes out a big chunk of your account. You repeat, it pops and drops, you wipe out another big thing. You get in this trader's death spiral. You have a series of small wins and bigger stops, and your P&L equity curve on your account's going down, mainly because you're not trading frequently enough. You're trading too small numbers of trades, and you're trading too large in terms of the P&L allocated to each trade. So flip that and test that in a demo account. So I know I got on a bit here, but from an authenticity and trading standpoint, you folks have been amazing, and I appreciate your support since 1999. I feel like I've been trading since dinosaurs roamed the earth, and there's a handful of good people to learn from. Make sure you learn from people like myself and my colleagues at the worldstoptraders.com site. Avoid the kids who don't know what they're talking about. Develop a trading plan based on these tips that I've shared with you, and hope that it helps you start making some small fine-tuning adjustments, both mentally and financially in your trades, so that you can start figuring out a difference in terms of where you've been trading and some small adjustments or transformational points, change points that you want to start making to trade more successfully. So if you like this, feel free to post a comment below. I know I haven't gotten a lot of comments here on the channel. That can change up to, it's up to you. I will answer questions if they're intelligent questions. Feel free to ask any kind of thoughtful question. I'll be happy to reply here. Subscribe if you're not yet a subscriber. Click the notification bell icon, I guess it tells you when there's a new video. And I'll see you guys in the upcoming events that I've got at www.trademastery.com. So until next time, you know the routine. Trade with passion, or at least with intelligence. Trade with real tight stops. Play the field, and let's go get them. So best wishes for success in your trades, and I'll see you guys next time. Bye for now.